Hello to you all, and thank you everyone for joining me on screen and for joining us this morning. We are really lucky to have so many different perspectives on this panel session, and I'm really looking forward to getting into the debate today. We've already done some introductions, so I will dive straight into the questions. So we've seen a lot of change in the market over the last year, which has made an already complex industry a little bit more challenging. What have you seen in your businesses, and what have been the biggest changes in this last year? Matthew, let me direct that one to you first.
Oh, wow. I think in terms of industry-wise, obviously, I think it's the volatility has been the single biggest change. I can't believe that the amount of changes, the significance of the changes, and just trying to manage that for brokers, lenders, everybody, frankly, has been absolutely incredible. Specifically in our business, because I think that's an industry-wide, that's an industry-wide point, really. But specifically for our business, coming from a more specialist angle, we have seen a huge increase in demand for the support for specialist services. So whether that's specialist placement, packaging, and that's not just down to needing help finding homes for cases because of all of this volatility that's going on. It's also because it's been so hard to get these cases through to completion. People who've perhaps turned their back on our other services, like the fees-free packaging element, are now saying, actually, we really value that, more than we ever have before. We want those extra levels of support. So I think that the demand for that extra support has shot through the roof.
Oh, brilliant. Thank you for that. I completely agree. It has become a very volatile market. And I think that's probably some answers we will see across the panel today. But Steph, what has Sesame Bankhall experienced?
I think I would totally agree with Matthew on the volatility. And I think, actually, one of the areas I'm going to talk about, I think, actually leads into it. So I think, one of the biggest changes has probably been for us and for everybody, really, that work from home. We're all sat here on this call today, so from our relative rooms in our houses. And I think, actually, though it was forced upon us, the sort of quick adaptation that we saw has actually just demonstrated the agility and resilience of the firms within the mortgage market. And I think, we've become more productive, and these efficiencies will continue as we move forward. And I think that sort of tech piece has played a real sort of vital role. It's actually played a real vital role in how we've worked with our advisors. So being able to move our events program to a virtual environment has allowed us to deliver, not just educational content, but as Matthew touched on, all these, this huge tsunami of changes that have come our way in a really informative way. It's allowed us to continue to have conversations with the likes of yourselves as lender partners. But I think for all the positives of that, I think actually, just giving Pete and working from home, it's had a little bit of a negative side. And I think for us as a business, allowing people to know that it's okay to not be okay and giving them a safe space to have a voice when they may be having a bad day has been really important. I think a focus on well-being when you work from home is vital, and you've got to feel as though you don't live where you work. That's probably been one of the biggest changes I think we've all probably encountered.
No, absolutely. I think adjustments in work life and personal lives, absolutely. So it's great, really refreshing to hear, definitely. And Stephen, what have you seen?
I completely resonate with you, Steph, in terms of how Sesame have dealt with the well-being of staff and everything. At Legal in general, we've seen that just the capacity of people has been stretched to as far as it can possibly be. So just making sure that we're taking care of our people at the same time, the accessibility for resource to make sure that they're looking after their physical health, their mental health and everything. The onus has been, it's been under a magnifying glass for people, not just in the intermediary space, but also people in our service centres across Legal in general, not just the Mortgage Club. And making sure that we're doing that for intermediaries, making sure that there is the support there with help desk, especially since there was the massive bottleneck in service this time last year with lenders, surveyors, and everything along the lines of that. Just making sure there was someone to turn to, whether it be a help desk at a mortgage club or at a lender. Just seeing that we've been able to be there on the front line for advisors, our customers, and everyone that's part of that journey. We've tried to push our technology agenda, if you will, to make sure that the accessibility is there for everyone, because there have been such a crazy amount of challenges that have presented themselves month on month for advisors to deal with. And yeah, it's just incredible that we're at this point now, and they don't seem to be stopping, but at least we're got our eyes on the light at the end of the tunnel with COVID.
No, absolutely, completely agree. And Craig, what has Kensington experienced?
I think probably what's really interesting is if I look at supply and demand over the last, God, it's been nearly 18 months, which is very depressing. Is if you look at last year, I think, you know, in the total market, you had this real dearth of supply because you had lots of lenders. Well, some lenders stopped lending. Happily, we didn't need to do that. Most lenders withdrew their LTVs or made some underwriting changes. So you had a lot less kind of products in the market. And lenders were also really constrained by staff moving into support servicing, because you had this huge spike in demand into servicing for payment holidays, and same as everybody else working from home and the challenges of that. So this real drop in kind of supply of mortgages and products, but at the same time you had this massive increase in demand because you've got the stamp duty holiday, the end of Help to Buy, and a lot of people just reevaluating their lives and where they want to live because of COVID, and you know, people moving out of town or deciding they want to live somewhere different, possibly even make renovations and needing kind of further advances and remortgages to do that. So there's real imbalance between decrease in supply of mortgages, but massive increase in demand, which is really stressful for brokers and customers when you're trying to place a case. And actually, it's really hard to place a case sometimes because everyone's reduced their criteria or their LTVs, or they've stopped lending. So that's been really hard. And then we had this kind of, you know, boom that we've seen certainly on completions in the last couple of months, with June just behind us, biggest month ever by far for Kensington. I'm sure probably the whole industry, it's just been crazy. So everyone's trying to land that. And then I'm hoping I think we'll see the pendulum swing. So actually, I think what we're starting to see and what we'll see post the end of the stamp duty holiday is a lot more supply, because lenders aren't now tied up with payment holiday requests, because most of the payment holidays have gone. Everyone's used to working from home, so they've got more kind of capacity from that perspective. So you've got much more kind of capacity in the market. But actually, I think what we're going to see is a drop in demand. Not drastically, but clearly we had this artificially high demand from the stamp duty holiday. So now I think we'll get back to a normal market where you've got lots of supply and lots of lenders wanting business and looking for business. And normal levels of demand, not low or crisis levels of demand, but just more normal levels of demand. So I think that will get the industry back to a much healthier place where lenders are out there looking for business, lenders are innovating, coming up with new products, but expecting rates to come under pressure, which, you know, possibly improves affordability, so it brings more people into the market. So I think we'll be in a much more healthy, stable position for the future. And certainly the focus at Kensington is how, you know, we've got really ambitious plans to grow. So how can we increase our supply? So that's, you know, doubling the number of underwriters, which we've done, recruited more salespeople, launched a new system so we can deal with more demand. But I think, you know, we'll have seen that pendulum swing, and it will go back to a much normal position where brokers aren't hopefully trying to find a place that will take that case, but actually there'll be lots of places that will take that case, and they're all trying to compete on service and price, which is absolutely what you want as a customer or a broker.
No, excellent. Thank you, Craig. And I suppose you touched on it a little bit there as well, that there has been this growing complexities within the marketplace. And I think that's really meant that we've seen the importance of mortgage brokers and specialist advice. So let me ask, how have you guys seen customer needs change, and what trends have you noticed in the industry lately? Steph, I'll come to you first on that one.
Wow, I think, you know, there's so many we could talk about here. I think the pandemic has affected so many people in so many different ways. So everybody's needs are going to be slightly different as we move forward. And what does the, you know, I hate the term new normal, but we are moving into a new normal, and what are they going to be? You know, Craig's just picked up really nicely there on sort of that sort of search for space that we've seen people do, that sort of move perhaps out of the city, you know, commute having a you know, or not having a commute, having a positive impact on that. But I think the biggest one that perhaps I'm a little bit sort of concerned about, I suppose, actually, as we move forward, is actually we've seen people's spending habits change as we've gone through the pandemic. Not mine per se, but other people's may have done. My Amazon delivery driver would definitely say mine have not changed. And we've seen record levels of debt being repaid. So sort of about, you know, I think the last figure I saw was sort of circa 17, 18 billion. And people amassing, you know, nearly 200 billion in savings, you know, before we started to come out of this lockdown. So this changing priority for people and repayment of debt actually could this put us in, and Matthew might have an opinion on this as well, could this put us into a bit of a false sense of security that actually we're not going to see a rise in adverse credit? I think it's been positive that we've seen the majority of people who took perhaps the wrongly phrased mortgage payment holidays. We've seen actually sort of positive impact and so many people going back to making those repayments afterwards. And actually, unfortunately, the customers who haven't been able to pay probably weren't in a position to pay pre-pandemic. So I suppose it's been fortunate in some ways, but actually, are we, you know, we're going to start seeing the withdrawal of the government support measures now. So are we actually going to start seeing customers who perhaps haven't been struggling as much start to struggle over the coming months? There's a lot of commentary around actually a lot of those people coming off government support measures in furlough perhaps might work in industries, maybe it's hospitality, slightly younger consumers that aren't property owners at the moment, but they are our property owners of the future. They're our first time buyers of the future. And as we all know on this call, well, you know, adverse credit can have an impact for a number of years. So I just, you know, it's just one trend that I think we're starting to, you know, I think we will start to see more of. We've already seen a little piece of, and one perhaps for the future.
I think we are certainly starting to see it now, Steph. I'll be, you know, to be honest, we are seeing people affected by payment holidays, you know, being marked up on their, you know, on their credit file as missed payments. We're seeing that already. We're also seeing a lot of recent adverse. In terms of how it will, you know, in my opinion on how it's going to affect the broader market, I think we have to realise that there's going to be a great deal of inequality that comes out of this. You know, the vast majority of people who are homeowners are not going to be affected by these problems. The economy seems to be standing up, and I think we're all probably surprised at how the market has really fared. I think if we'd asked this question in April of last year, we might have had a very different outlook on that. So probably goes to show what I know. But it's those who are struggling to get on the ladders that you referenced, Steph, that will be getting into this recent adverse that's going to be on their record for a while and cause problems down the line. So yeah, we're certainly seeing the start of that. I don't know the scale of it and where that switches, because you're right, overall the trend is a repayment of, you know, a repayment of debt. I think that the inequality is the bit that concerns me. I think it's those that are in that specialist camp trying to get on the ladder, that's where the real problems are going to be. I don't think that your high street clients are going to be that, you know, are going to be that affected. And that's where specialist markets come into their own, really. It's working out what was a temporary problem for a legitimate reason, and, you know, what is a good client in a good situation, isn't it? So I think that that's really positive for brokers and the broker involvement. We've talked already about the demand. I think, Eloise, you mentioned it earlier, the demand for brokers that has shot up. And I don't think that's going anywhere in the next few years, because the fallout from this, and Stephen's right, you know, hopefully we're getting through this, fingers crossed, but the fallout's going to be with us for a while. So in terms of customer needs changing, I think there's that ongoing need for broker, you know, for broker support. I think that's up and high. Not for everybody, but I certainly think that the cohort of people needing broker support is up, and we're going to have these pandemic related issues that are going to wash through. So unfortunately for society as a whole, that would be the case. But I think it's good news for brokers to be selfish about it, and to be honest, we're probably in a better shape than we were when we were all kind of sent home to work initially. I think so we stay positive on that front.
No, excellent. Thank you both. Some really good points there. And Stephen, I know you have experience on both Legal & General's mortgage desk and now as a telephone relationship manager as well. So what trends and changes have you seen in these roles?
What hasn't happened? There's been loads. In all fairness, it's The news is changing every week with the changes that have been happening in the mortgage market, but I think a couple of salient points that we've seen, especially given how the mortgage market has been split with branches being closed on the high street, and the intermediary share of the market had increased to 80%, which is a massive opportunity for advisors. And it really underlines the value of advice, especially if you can't go and reach out and grab it. It's not tangible on the high street. It's something that you have to go and speak to an advisor for. With that, the fluency of advisors with the likes of specialist and niche products, the riches are in the niches, is what they say. The niche lending in the market, I think, accounts for about 27%. And that's something where we're seeing that the David and Goliath story of where people haven't necessarily been able to find the means to an end if they have bad credit or maybe have something spotty on the record. We talk about things being vanilla and things being spicy. The appetite for spice is greater than it's ever been before. So we're not leaning on the likes of those lenders on the high street for all of that specialist capacity. They're even changing their own agenda so that they can make a bit more moves towards specialist stuff, but still the appetite's not there for our high street lenders. It's still lenders along the lines of Kensington that have got that appetite, that are able to help those that are quirkier than what we might expect. Customers that are like me that might have missed a couple of payments, but I've got a tenner waistcoat on. Maybe I look like I could be rich, and possibly the appearance of what might be a fantastic customer, and maybe my habits of thinking it might be coming home recently, that it could be looked on unfairly by someone on the high street. It's up for advisors to take those opportunities in their hand and run with it now, especially with product maturities for the PRA tax changes a couple of years ago. There's lots of things like that that are going to reach a critical mass later on in the year that we're really wanting to take advantage of now.
Excellent. No, thank you so much. And Craig, from a lender's perspective.
Well, the first thing I'd say is I'm not sure we'd go into the depth of looking at Stephen's waistcoat habit in terms of when we're assessing affordability. So that's good, as long as it's not too excessive. I think we'd be fairly comfortable with that. I think probably the key thing for us is real focus on self-employed, which we naturally do as a lender because it's kind of, you know, half of what we write. But they have been so impacted by the kind of the pandemic. So obviously a lot of employed people have as well, especially clearly in certain sectors if they've been furloughed or made redundant. But with self-employed, they've had in terms of their life's got so much more complex. And from a lender's perspective, and from a broker's perspective, what are you going to do about bounce back loans? What are you going to do about the government grants? What do you do if the self-employed businesses have furlough income? So I think that's a whole, self-employed's complex anyway, and it's just added a whole level of complexity to it because most businesses will have had probably one of those three things. So that's really increased the kind of demand to us. We've now got, you know, a really flexible self-employed policy where we'll accept all those things, and we absolutely won't penalise people for that. But I think it's also really important for the future because in the last crisis, the financial crisis, what we see is a lot of people who are made redundant. You see a big growth in self-employed businesses. So a lot of people respond to that by setting up their own businesses, which is fantastic. And of course, as an economy and as a country, we want to encourage that innovation and, you know, people looking after themselves and being made redundant, but then just going out and doing something for themselves, which is superb. So I think we'll get more and more self-employed people. That was certainly the evidence in the last pandemic. So having those kind of flexible policies and really trying to understand what's happened and, you know, and understand where things were just a one-off that won't be repeated. So why would you penalise someone for having a government grant when the business is back to normal, or taking furlough income, or having the bounce back loan? Absolutely not. So I think coming up with those kind of really favourable policies so that we can take the vanilla and the spice.
Excellent. I'm starting to get hungry now. Thank you. So this year especially, we've also seen, as well as a lot of change, the integration of technology in both our personal and working lives, connecting colleagues and customers alike. But we've also seen new customer and broker needs emerging. So what do you guys want to see from lenders, and what do you want to see us moving towards in these areas? Stephen, I'll come to you first on this one.
Same as you asked in the last question, loads and loads. There's always room for improvement, regardless if you're an intermediary lender or a mortgage club, and it's trying to keep the eye on innovating and constantly trying to get the screwdriver in the back or the bonnet up, whichever vernacular you like to use. Technology is just so massive in driving that change for lenders and everyone that's part of the journey. And the mortgage market's not exempt from any change. There's massive steps the likes of the insurance market has made with comparing products and things like that that are so easy for customers to get online and do. Whereas we're seeing a lot of advisors meeting those hurdles constantly on trying to make sure that products are up to date and everything's available, that they've got full vigilance and autonomy to give the best advice that they can do for everything that's available there. From things like lenders being on board with API and integration technology to make sure that maybe their CRM that the advisor is using can link into possibly submitting a singular fact find for loads of lenders at once. Things like electronic ID and B. Why is it that ID needs to be checked 4 times in a process over and over again when it can be copied once electronically and sent off in its respective places it needs to go to? It's just making sure that that accessibility is there from criteria, the likes of smarter criteria we have available for free for advisors to jump onto straight away and check the criteria, go further to smarter fit, check the affordability, and make sure that they are given that advice from the crow's nest, and making sure that they don't have to go further afield and maybe miss out on that deal when it suddenly comes off their sourcing system because all of the facts weren't there and available for them immediately. Would love to see lenders adopting more of that mindset of change and innovation and getting on the technology agenda sooner rather than later.
Excellent, no, brilliant, thank you. And Steph, what are your thoughts?
I think I would agree. APIs, CRMs, open banking, they all make great efficiencies for sort of lenders and advisors. But I think what we need to be is mindful of actually what does a customer really want, and actually what they want is they want a quick decision, but they want confidence in that lending decision as well. So I think it's that reassurance that alongside the advice that they receive from the advisor, actually that yes or that no, whichever way, but I mean that yes decision is a yes firm decision. But I think there's also another play on that actually, we've seen, some really fantastic systems that can give you a mortgage offer in, 10 minutes. That's a great surety of decision, but actually that doesn't speed up the rest of the process. So, how do we actually make sure that we don't get siloed into looking at one area of the actual journey, and actually we look at the, technology solutions all the way through, right from that initial sort of property search through to completion, so the conveyancing aspect, but also bringing in, making sure that holistic conversation around protection and GI. And I think integration across the piece is actually probably where we need to get to. I think for us, from an SBG distributor perspective, we just want lenders to share where their thinking is. What's your plans be? We can facilitate that collaboration if we're having open and honest conversations. There's not going to be one system that's going to have a solution for everything in the space, but the more conversations that everybody has, the more aligned everybody becomes in our thinking and our plans as we all start to build.
Oh, brilliant, thank you for that, Steph. And Matthew, can you tell us your thoughts on that as well?
Well, I think the idea of a uniform process, or a unifying process, at least I wouldn't say uniform, but I think that's the dream. But I think that technology over the years has shown consistently that the dream is always further off than we ever think. And it is crazy right now that a broker can run their own EID and verification for a customer, and then everybody goes through that process, as Stephen said. You know, it's crazy, but you know, it's solving these problems will be, you know, fantastic. Same goes for open banking. You know, brokers can plumb into open banking, credit file access, all of that stuff, but the lender that they choose then requires best outcome for customer, then asks for all of the documentation to be done. So you are in a situation where I think we're quite a way off managing to actually pull all of that together for the industry as a whole. But that really is the gold standard, and we should be moving towards that. For us, Steph said that this is what the customer experience is about, and the customer experience comes first there. But before that, I really want to you know, we've spoken about service, and I think it was Stephen who spoke about the backlogs and the problems that we've had this year. And for me, we've got to focus on the quick wins that we can gain from technology. Look at the quick wins that we had, that we were able to achieve, that lockdown forced us into, that Steph mentioned earlier on. All of those online virtual conferences, this event itself, it comes from the back of adversity and need. And right now, we've been through some incredibly difficult service times. And, you know, big thing for me is focusing on freeing up the service and support, you know, with lenders, so that brokers aren't on hold. You know, talk to brokers about some of their big bugbears, and it's being sat on hold for a long time, trying to talk to somebody to get something done. All right, and for all of the online systems, and for everything, especially in the specialist sector, for all of the online systems and technology, I want it to be used in the right way, and that's to free up people who know what they're talking about to get involved and make the decisions and have that communication with brokers and solve some of those problems. And I think those are quicker wins. You know, I'd want to see the time freed up so that we can focus on service, and we move towards that kind of grand aim of everything being tied up. So that's what I would like there. You know, we see lenders that don't have chat facilities, you know, and we have to queue up to talk to somebody, when actually that could be done on a chat function. They seem to work well. Obviously not for, you know, not for everything, but it's little things like that that are there, the low-hanging fruit that I would, you know, I would really encourage the industry to adapt. And one of those would be, you know, and hats off to Kensington for this, but, you know, digital signatures, and, you know, adopting the work that you've done there. I mean, where is everybody else with this? Why aren't we seeing? I know it's coming, but it's, you know, it's not that difficult to do. It's not that difficult to achieve, and it makes a big difference. So my kind of real drive here is to encourage the low-hanging fruit and the quick wins, because technology is an iterative process, and, you know, we will get there in the end. But slowly but surely we will get there, and the improvements that can be made quite quickly can be quite significant. And so yeah, I think that Kensington are going on the right path. You know, I will say, I wouldn't say it otherwise, but it's a good example of what we would like from, you know, from others in the space. And I hope you will continue in that vein.
Well, excellent. Well, I think that gives me a perfect opportunity to hand over to Craig then, really, as well.
No, that's brilliant, and thank you for that, Matthew. But I think the key thing is we're doing a whole piece of work at the moment, understanding what brokers want and why. We've got, so if we look at BDU, for instance, we've got the 24/7 robo chat, so the robot gives the answer through artificial intelligence. Then you've got the live chat, and then you can actually speak to a BDU. But we also, which is great, and a lot of those have been launched in the last year and have really helped, especially when we're really busy. But we need to do more work on understanding why a broker's phoning. Is it because our policy is not clear enough? Is it because they can't find what they need on the website? Because ultimately, if a broker just knew, you know, people are always going to need to phone in for the really complex things. But a lot of it will be failure demands. So we've failed because brokers aren't clear on what we sell and what we don't sell. And actually, I think we probably need to do better at what we don't do, because so many calls we get are, do you do this? Well, actually, we don't. Well, it's just kind of wasted our time and the broker's time. If we found a better way of telling the broker that, it would save their time. So I think we need to do more on understanding why brokers call and what they need to do, and helping them get those answers quicker. But also things like, we've got all that in the BDU, but then actually I don't have that in the pre-offer team. So when you phone to speak to the underwriting team, when you've submitted a case, We don't have web chat and we don't have robo chat, so that's what we want to look at next, because we need to have it all the way through the process. And then maybe how do you communicate with an underwriter? That's still quite old-fashioned. So we need to look at it all the way through the process. It's not just on the front end. So I think that's a key task to get that level of consistency. And then I think just the sheer, and it's why brokers phone, is the sheer level of change. Is an amazing stat I got from 27 Tech, is that between all the lenders, between changing product criteria, pricing and affordability, there's 10,000 changes a week that lenders make, which is why everyone phones the BDU, because it's like, do you still do this? And what's your rate on that? Because it just changes all the time. So using the tools we have to navigate that maze for brokers and customers, I think is really important. And in some ways that's great. There's that level of complexity because it means customers can't do it themselves. They need a mortgage broker. But we need to make it simpler and easier for brokers to understand, because, you know, hats off to brokers. How do you manage 10,000 changes a week and know, yeah, this is where I need to place that case? So I think we need to do a lot of work on how do we just streamline those things and help make that match between lender and broker easier.
Brilliant, and thank you, Craig, and thank you everyone. That brings us to the end of the questions. Hopefully that's provided some really good insight for the intermediaries who are watching today. But just wanted to say a huge thank you to Steph, Stephen, Matthew, and of course Craig as well for joining us this morning and for sharing your thoughts. So thank you very much.